Hello, I'm Larry Pond. I'm a CPA here in Redwood Shores, California, and I'm entering my 36th tax season. And today we're going to talk about what you need to know about federal taxes and your business. I'm a financial literacy volunteer for Cal CPA, and as such, I'm also volunteering for the Internal Revenue Service. So, as such, I'm going to read this disclaimer to you before we get started. The instructor for this program volunteers his or her services as a public service and receives no compensation from the Internal Revenue Service, the IRS. Neither the instructor, business, or organization has a preferred relationship with the IRS. The IRS and the United States government do not endorse or guarantee the use of the instructor's services or business. Sponsoring or not sponsoring any organization with which the instructor has any relationship will not result in any special treatment from the Internal Revenue Service. So now that we got through this disclaimer, let's get started on our topic today. What you need to know about your federal taxes and your business. So let's get started with your identification number, the employer identification number, also known as the FEIN. Now, you have to have that for your business. You can't use your social security number. Your business will have to get its own employer identification number. And you need this to be able to pay wages, to set up your own self-employment retirement plan. If you set up a partnership or corporation, which are separate people for tax purposes, or if you need to file employment taxes, excise taxes, fiduciary taxes, or other tax returns. And banks and other businesses may require an EIN or FEIN. So how do you get that? You can get it online from the IRS. You go to www.irs.gov and click on ETN for the keyword. It'll take you to the online form SS4. You fill it out very carefully, though, because if you don't fill it out right, you might confuse the IRS and might tell them you have the wrong type of business. So read the questions carefully before you answer them. Don't go through it too quickly. You can get more information from publication 1635, Employer Identification Number, Understanding Your EIN. And I think it's a good idea to get one, even if you're self-employed, because your clients might want your social security number. Well, instead of giving them your social security number, you give them your employer identification number. That's another way of protecting your privacy. Always a good idea to get that. So when you have a business, you gotta keep good records. You can't just make up numbers or make them up off the top of your head, because I don't know about you, but I can't remember anything. So keep good records. Keep all documents verifying income, purchases, deductions, and credits. Now, this slide says the minimum amount of time is 3 years. I'd say that's the absolute minimum amount of time. Employment taxes, 4 years. Those are for payroll taxes, and that's in publication 15. For business property, the life of the asset. As long as you have the asset, you got to keep those records. For me, I'd like to see you keep the documents for at least 7 years to play it safe. Now you can look at publication 583, starting a business and keeping records. In case of an audit doesn't mean you did anything wrong. The IRS might just want you to prove some numbers you claim on the tax return. That's all an audit is all about. And they might not ask for every line of the tax return. It could be selective lines, but it's a good idea to keep good records. And in terms of bookkeeping, you can do what's called single entry bookkeeping, which is the easiest way to go. Basically, it's a spreadsheet or a worksheet of your daily and monthly record of income expenses. You have a sheet of all your totals. If you have a retail business, you have a cash register, um, and you can keep track of just on a sheet of paper income and your expenses. And this is just a focus in your profit and loss statements. This is not for creating a balance sheet. It's just for a profit and loss statement. And for tax purposes, that should be good enough. However, double entry accounting is much more accurate because that's how you can check to make sure the numbers are right, because you have what's called built-in checks and balances. So when you can balance, you know it's right. If it's out of balance, something is wrong. So double entry accounting. So basically, you have a debit and a credit. So that's what double entry accounting is. There's a lot of software you can get that's pretty easy to use. Some of it's pretty close to being automatic. If you pay all your expenses through credit cards, the credit card company will keep track of those costs for you. If you pay your bills of online banking, that's all being recorded. So you have a record of who you paid to and what it's for. Now, another tip with bookkeeping is do not mix personal expenses with business expenses. So you should have a checking account just for your business. You should have a credit card just for your business. And then keep it separate from your personal credit card or your personal checking account. That will make your bookkeeping so much easier. You don't want to commingle the amounts. So I'm an accountant. I'm a CPA. So you have to be aware of accounting methods. So most of us will be using the cash method of accounting. Publication 538 will have a description of that. So cash method accounting means you report income in the year it's received. So let's say you send your customer an invoice for $10,000, but you don't get paid till January. Well, under the cash method of accounting, that's not income until next year because you got in January. Same thing with expenses. You deduct the expenses in the year it's paid. So I paid my costs before December 31st. I can deduct those. Accrual method of accounting is you report income the year it's earned. So for example, I send my customer an invoice for $10,000. I've earned it. He owes me $10,000. Well, that's income under the accrual method. Same thing with expenses. You deduct the expenses in the year incurred. So you might have what's called accounts payable for an expense, even though you haven't paid the accounts payable yet, but it could be deductible. Under the accrual method, you have to use the accrual method of accounting when you have inventory. You're selling products. You're a store. You're selling products. You're maintaining inventory. You got product coming in, and you're selling product. So be aware of your method of accounting, and that's a box to check on the tax return to let the IRS know which method of accounting you're using. Now, you can't bounce back and forth on which gives you the better answer. Well, this year I use cash, and this year I use accrual. No, you're stuck with the method you pick. You can't keep switching back and forth. You can, but it's incredibly complicated and not recommended. So once you pick a method, you stick with it. Pick the method that's most appropriate for your business. For most taxpayers, it's the cash method of accounting. Now, when you're starting a business, you've got what's called a choice of entity or business structures to choose from. And it depends on what your needs are. It's not a really easy answer here, but the choices are: you have sole proprietor, which is the simplest and easy way to go. That's report on Schedule C as part of your 1040. You could be a partnership. A partnership means you have more than one owner. You have a ownership with someone else, and that's reported on Form 1065 and needs its own federal ID number. Or you could be a limited liability company, which is taxed like a partnership. Or to make it more confusing, you can elect to have it taxed as an S corporation. It's called check the box regulations there. Limited liability company. That's a relatively new entity. I think most of the states have those. Now in California, we have it. And then you can be a corporation. Now you can be either an S corporation or a C corporation, a regular corporation. Each of them have its own special tax rules and requirements and things to look out for when you choose a specific business structure. Each has their pros and cons. So let's talk about the sole proprietor. That's an unincorporated owner. Business is unincorporated. So what that means is you, the owner, and the business are one and the same. It's owned by one person. You could get a federal ID number for it, which I recommend because that protects your privacy. Or if you decide not to, you just use your social security number. As a business owner, you assume all the risks. And so you assume all the risks to the extent of all your personal and business assets. There's no liability protection. And you file Form 1040 with Schedule C for the sole proprietorship and SE for the self-employment tax. Now, a sole proprietor can also have what's called a qualified joint venture, which is not necessarily a partnership, but it's doing business with someone else as a joint venture. I like to call it as if you're dating. You're doing a joint venture, that's just dating. If you're doing a partnership, that's getting married. You are connected. So partnerships, it's under state law. It could be relatively easy to organize. If you're doing a business partnership, they're mostly general partnerships. A limited partnership would be a partnership where you have investors and the investors are limited partners, but it's usually run by the general partner. So the members or the partners contribute money, property, labor, or skills. I highly recommend a written partnership agreement with a competent lawyer who understands this type of law, because that way there's no confusion about what happens if you want to add a partner wants to leave, a partner dies, a partner gets disabled. How do we split up the profits and all those sort of issues? Get it in writing. That way there's a less of a chance of an argument. The members share in profits and losses, and that's what the written partnership agreement is going to state. How is it shared? Is it shared equally or not? A decision authority is divided. You can have someone in charge, a managing partner, and the other partners are not. Now, limited partners would have limited liabilities. However, general partners will have unlimited liability, just like a sole proprietorship. The income flows to your personal tax return on Form 1065 Schedule K1. Take a look at Publication 541 on partnerships. Limited liability company. Now, it's similar to a partnership. It's more recent legislation. It's been around for, depending which state you're in, about 20 years. California's been around for almost 20 years. Our owners can have limited personal liability, but you got to look very carefully about that. It's just like a partnership. It provides management flexibility and flow through taxation, which means the income gets reported on a Schedule K1. But you can make an election to treat it as a sole proprietorship, a partnership, or a corporation. Now, a limited liability company, a limited liability partnership, those are for professional business like a CPA firm, a law firm, or a medical practice, something like that. But to make those decisions, do I want to be taxed as a corporation or a partnership? You file Form 8832, Entity Classification Election. Once you make that option, you're pretty much stuck with it. You can't keep switching off from year to year. You can't do that. Once you make a decision, you're basically stuck with it. So you have to be careful about that. Carefully think it out. It's not a 5-minute decision. It can take more time than that. S corporation. So S corporation is a regular corporation where you file a Form 2553, election by small business corporation. And it basically has, it's being taxed like a partnership. So you have flow through entity.
I didn't understand that.
An S corporation does not pay tax on the income from daily operations. So the income flows through to the shareholders. And then the shareholders report the income on their personal tax returns. One thing you got to look out for, if you set up an S corporation and you are by definition officer of a corporation, you have to get a W-2. You're an employee of the corporation. So that's something you need to be aware of. For a partnership or a sole proprietorship, You cannot be an employee. You're the owner, you're the operator. You cannot be an employee. So no W-2s from Schedule C or a partnership. A corporation, a C corporation, it's a separate legal entity and it pays its own taxes, unlike an S corporation. S corporation doesn't pay any federal taxes. The income flows through. In California, there's a 1.5% tax on the net income of an S corporation. A C corporation is a separate entity, separate person, and separate from the owners. So it gives the most amount of legal liability protection, has legal limited liability to the shareholders. The owners are the stockholders or the shareholders. And it's pretty easy to transfer ownership of a corporation. You just sell the stock. You have a stock certificate and you can sell the stock to anybody else. And if you want to expand the business, you can sell the stock to other people. You have to raise capital. Now, if you want to go there, there are some laws you got to be aware of. They're called securities law, and they're very complicated. So if you want to go there, you definitely need to get a lawyer who specializes in securities law. It pays its own taxes. And under current law today, corporations pay a flat tax at 21%. So that's what corporations are paying right now, flat 21% tax. Any net income that's distributed to the owners is distributed as dividends. But again, if you're a officer of the corporation, so by definition, you're an employee, so you have to get a W-2 from your corporation. Now, it's regulated by the Secretary of State, so you have to incorporate through the Secretary of State. You apply for a charter through the state government. It's in the state where the principal business activity occurs. The charter permits corporations to sell stock to shareholders, empowers the corporation to create debt separate from the shareholders. So the form that's filed by a corporation is Form 1120. Now, there's always a question on which state should I incorporate. Well, if you're in California, you work in California, you do everything in California, you just incorporate in California. It doesn't make sense to incorporate another state because then you're paying taxes and fees in other states for no reason at all. Since we're in California, just incorporate in California. Don't make it too complicated. So we just talked about the basics of federal taxes and your business. And thank you for your time today. We have more videos that you'll be seeing. If there's other topics you'd like to see us cover, let us know. If you like us to do a live presentation for your group, we'd be more than happy to do it. You can reach out to me at the contact information on the screen. Well, thank you for your time today, and I'll see you again. Thank you very much. Bye-bye.